Now we're going to hit record in three, whoop, three, two. Welcome to another episode of Million Dollar Stories, where we get to interview authors from all over the world. I love talking to authors because they have a commitment level that far exceeds most, but they can take their courage, their thoughts, their stories, their lessons, and make it tangible in a book form. And you could use it to, change your legacy and create an unbelievable, maybe whether it's a revenue stream or just a pathway in life. And so if you're looking to write a book out there, check out dreamstarterspublishing.com. We can help you out with wherever you're at in the process. And if you already have a book that's done, you want to generate leads with it for your business, check out bookmarketingcrm.com. I'm excited about this conversation because as a finance major, as a small business owner, as a guy who understands now how important it is to look at the numbers consistently, this is going to be a great value add for you listeners out there who are looking to start or grow a business, putting together those financial statements, not only for you, your team, but also potentially investors. So the book that we're discussing today is called Financial Accounting and Reporting for Non-Accounting Students: How to Interpret Financial Statements and Appraise Company Performance. That's huge. So we have the author with us today, Stephen Frost. Thanks so much for being here, man.
Hi, Mike. Thanks for inviting me.
Well, let's start off with the genesis of this book. Maybe if you really want to tie in your background, where you come from, what got you to this point, and why you wrote this book.
So my background is I'm an investment analyst. So my job was not to prepare financial statements, but to interpret them. I'm a CFA charter holder rather than a chartered accountant. So I'm not interested in the debits and credit side of the
accounting. Good. Then we like you even more then.
I believe you can explain and teach and learn financial accounting principles using plain language rather than the jargon that accountants often use. I think that gets in the way of reading financial statements and understanding what's going on. And also one of the big takeaways for me as a financial analyst was understanding that management are trying to sell you a particular story, and they're using the financial statements to try to make themselves look as good as possible. And at the same time, I've also seen lots of examples of companies failing where auditors have not said anything in advance of them failing. And the more you look at the audit profession, the more questionable they are in terms of competence and independence. So that's the background in terms of it. And then I joined at Loughborough University about 11 years ago, and I've been teaching generalists how to read and interpret financial statements really since then. And the books that were out there, and there's a really important date here, they all predate 29th of June 2007, which of course is the day when the first iPhone was introduced. And what I've tried to do is to write a book which is suitable for people of the iPhone age, the smartphone age. You won't see any full pages of text. You'll see lots of bullet points. You'll see short paragraphs, direct sentences. I write like an investment analyst would write in a sell report. I'm very direct, very clear. I've tried to I've taken complex ideas and I've broken them down into much more manageable chunks. So it's very readable. And I've used real life examples to illustrate key concepts and key principles. So that's basically the genesis. It is that there wasn't a book out there which my students would engage with. They're all very turgid, very long. They don't understand that students today, they are very outcome oriented. They want to learn to achieve a goal rather than read for the purposes of learning more generally. So I've put in lots of exercises so that they can learn through doing things, by doing extended problems, by testing themselves there are hundreds of multiple choice questions, testing multiple choice questions, and also learning quizzes. So it's very hands-on from that point of view.
Gotcha. Well, one of the greatest pieces of advice that I ever received early on in my venture was build your company as if you're going to sell it. And I kept saying to myself and to other people, I never want to sell this. This is my baby. I'm going to build this. This is going to be my destiny. This will be my legacy. I'm excited about it. Why would I even think about selling it? That's foolish. Well, even if you do keep it for the rest of your life and you hand it down to other generations or to other people, or you give it away to charity. If you build it in a way that's sellable, you do certain things that make it an attractive asset. And when I started to comprehend that and implement it, it made me build it in a way where I understood SOPs, but really to understand financial accounting to such a much higher degree and accurate bookkeeping. And it also made me realize that sometimes that the obvious approach is, well, at the end of the year, you want to reinvest in your company so you pay as little at tax time as possible. But let's just say you are going to sell it within 5 years. That's actually going to hurt you. The multiple will just decrease tremendously. And so I would assume that whenever you work with these companies or companies you've seen, they've made many mistakes that they didn't build it in a way that it will be sellable years from then. And also potentially they did things that undercut the value of the asset. So would you agree with me that that is a great takeaway? Build it as if you're going to sell it, even if you have no intention of selling it?
I think it's really important to understand the metrics that investors will be looking at and make sure that when you're managing your company that you're giving them the right numbers in terms of these key investor metrics. And I'm thinking about things like return on capital employed, but also the working capital measures like inventory days and receivables and payables, all of those metrics, which to an expert reader, they tell you about the financial health of the company. And if you've got 2 or 3 years worth of data, you can see whether this is a company which is on an upward trajectory, whether it's basically going nowhere or whether it's actually deteriorating. Because you've got to reinvest in the business. That you can't pay everything out. You've got to get the balance right between reinvesting for growth and paying out a return to investors.
Mm-hmm. And so you've been at the table where companies are about to sell or buy, and you probably have noticed that there's a certain trend, like you said, return on capital invested. What's the return on capital invested? What are some of the most significant numbers they're looking for? In my opinion, in the world that I come from, the cash flow statement is by far one of the top number one go-to sources for, is this something that I want to invest in? Now, I'm assuming that changes if you go into different industries like maybe tech or software. But in my opinion, that's what I look for if I'm going to invest in a company, because I'm looking for cash flow and appreciation. So I want two birds with one stone, I guess. So what have you noticed?
I guess the takeaway is that really that we've got 3 financial statements which are integrated. That they all tell you a slightly different story. But if you give me a statement of an income statement and a balance sheet, I can derive a statement of cash flows for you. That they're completely integrated. They just give you different views of what's going on. But the statement of cash flows is really helpful because if you look at cash flows from operating activities, now that is the lifeblood of the firm. And unless that's a big positive number, unless you've got a company in the very early stages where it may be negative because you're growing rapidly and you're spending lots of money on marketing and working capital is growing fast. But for a more mature company, that is the money which is going to be capable of being reinvested in the firm for growth and also give investors a return. And unlike profit, which is a number that can be manipulated by management, it's much, much harder to manipulate the change in cash at the end of the accounting period. But I look at all of them. I think the income statement, it gives you a better sense of what's happening to the underlying state of the company because it smooths things out. The balance sheet tells you what the financial health is of the company at a moment in time. And the statement of cash flows gives you insights into how much cash has been generated from operations, how much cash is being reinvested in the business, and how much is left over to pay everybody else.
So, in accordance to some of the businesses that you have been a part of or you've witnessed the transaction firsthand, is there a common trend that you study certain types of businesses? I'm around a lot of real estate guys, and I would think that real estate is its own little box that you are looking all at the same things. But I'm also in some circles with tech, and I would assume that investors are looking for two different things in two
They
different
are.
industries, right?
They're very different because and in fact they're opposite extremes. So your real estate business is not about an earnings number. It's about assets. It's
Yes.
about the value of assets, and those are tangible assets that you can go and feel, and you can get valuations on those. Now, people may differ on the valuations, but nevertheless, they are tangible, and you can see them and you can feel them. And it doesn't so much matter how much profit the company may or may not have reported last year. What matters is how much are its assets worth, and how much can it sell them for. So that's the real estate world, which is all about bricks and mortars and numbers which appear in financial statements. Then we move to the technology side. Now, technology side is very different because, and this is one of the strange things about accounting, which is that there are two things that are valuable in companies which do not appear in financial statements. The first is people. The capital of people never appears. So if you've got marketing companies where it's the creatives who give the value to the firm, they may not have much in the way of assets because their assets in terms of financial statements, because their assets are primarily people. But then the other very odd thing is that for software, which is generated internally by companies and patents and everything else like that, what we call intangible assets, these assets do not appear in the financial statements anywhere. So if you look at the likes of Google or Apple, all of that fantastic intellectual property that they own does not appear anywhere in the financial statements. It's invisible. It's an invisible asset. So that creates real challenges in terms of how do you value something which is invisible, and you value it. There's a number of ways that you can go about doing it. One of them is to see what cash are those intangible assets that you can't see generating. The other way to do it is to basically do, and I haven't done this in my book, which is more introductory, is to look at how much R&D the company is investing in its intangible assets and capitalizing it, treating it much more as though it was how you treated the accounting of the construction of a building. So and then amortizing that intangible assets over time to try to put the companies like tech companies where the real value does not appear in the financial statements, put them more on a par with the real estate company where it all does. It's one of the big limitations of financial reporting is that it's backward looking. It tells you where we've come from, but it also misses out on these two big asset classes in terms of reporting: intangible assets, intellectual property, and people.
Yeah, I like how you use that phrase, invisible assets, because one thing that I've really focused on the past 18 months is contact lists of people who potentially are interested in the services that we offer. So I have a list of probably a contact data point of either people who are looking to write a book or have a book of 8,500 people. Of those people, probably we've worked with 450, 500. And so I keep saying to myself, all right, what is the value to this list? And I try to put numbers to it just to see, an increase from month to month, quarter to quarter, year to year. It's very difficult. So is there any pointers that you could provide me or anybody else listening about contact lists and customer lists?
Well, so the accounting standard. So well, you have that list at the moment, and it's invisible. If I come to you and buy that list from you, then in my accounts, it will appear in the accounts to the value of how much I paid for you. And that crystallizes the valuation from an accounting perspective. It always had the same value in economic terms. But while you owned it, it was invisible. As soon as I buy it, it becomes visible because we've got a value on it.
Yeah, right.
Now let's assume a different case, which is that I don't buy your list directly from you. I buy the company which owns that list. Now, what we now have to do is we'll have to value that list separately because you've got a whole load of other stuff. And that really comes back to your question. So what would we do? Well, we would try to find similar sales of customer lists in the past and see if we can get some reference prices to see how much other people were willing to pay for similar sorts of lists of value. So that's the first thing we'll do. The second is that we're trying to work out if there's any way where we can work out what cash flows that list could generate in the future. And then what we're trying to do is discount those cash flows back to today to try to put a discounted cash flow value on the list. So that's what we'd do if it was part of an acquisition of the company rather than buying the list. That's the way that people go about trying to do it. It's not a science.
Yeah. And so you're saying something that is even different than the way I looked at it, where it's really about what other people have paid for similar lists rather than what this list could do for me. That's an assumption. And what you're really trying to do is get historical data that gives a somewhat accurate representation. And so there are appraisers out there, right? Maybe if you can explain this to our listeners of how this is done, but there are appraisers out there who this is their only job, or their only
This
job
is their job, yes. These
right?
are specialists.
What does that look like? Because I have not been at a table to sell a business yet. I have had clients that have done it, but what is that appraiser looking at? What do they do? And exactly if you can outline that, because to me, that's such a value add.
I've not been through the process. What I've done is I've seen these lists appear in
Oh, okay.
financial statements when one company has bought another company, and part of the assets that it has acquired has been customer lists. And somebody has gone in and valued that list either on a comparable basis, looking at the sale of similar lists, or they've done it on a DCF basis. But I've never actually met a specialized person who does that work, but I know they exist.
Yeah, I think that you really want to do certain things in a way that whenever the deal, gets inked, you want to make it as easy as possible for them to prove your numbers correctly. And I think that many people talk a big game, but maybe their books are out of order. Maybe their contact list data is out of date, and it'll crush them whenever it comes time to finalize the deal. And it really makes me think of bookkeeping issues. So one thing we focused on the past, I guess you could say 6 months, is more frequent bookkeeping records. Okay. So rather than do it once a month, which is what we were shooting for, we were doing it maybe once every 2 months, once a month, once every 2 months. Now we're trying to get it down to once a week. Right. And I think that is such a value increaser for a company. So accurate bookkeeping, I know you talk about it in your first chapter of how crucial that is. And what do you recommend when it comes to putting it all together when you're a startup business like our average listener? What is the right setup? What's the right procedure that you recommend?
It's a balance. It's a balance. But as we get increasingly powerful accounting systems, I think in the fullness of time we will get away from having periodic accounting. It will be real-time accounting. So that because at the moment we still have a batch approach to accounting periods.
Well said. Yes.
And accounting periods are useful for giving summaries of what happened during a period of time, but they're not useful from the point of view of having a process at the end of the accounting period where you sort out where there are errors and things. I think we'll get to a stage where, and this is getting away from the book, but we'll get to a stage where blockchain and things like that means that when there are transactions between two companies, they will be verified at the time the transaction is taking place. And you'll never get the errors entering the system in the place that you get at the moment, because there's always a question of verifying that what the supplier sent you is what you received, and what you paid them is what they received, and all of that. If you get transactions which are blockchain encrypted and they're verified at the time of execution, then you won't have this end of accounting period checking that everything is, correcting errors. Everything will be correct at the time. In the UK at the moment, we've had a big switch in the companies which have to pay tax on sales. They used to do it at the end of each year, and now they're doing it pretty much real time. They have to file their accounts on a monthly basis online.
Wow.
Yeah, it's an incredible change. I mean, it's an incredible change from being done in arrears in effect to almost being real time. The information tells you what's going with your company, and the more on top of that information you are, the better you can manage your organization. No, but obviously there's a cost. You don't want to be spending all of your time doing it, but I think it will get easier as we get more powerful accounting support.
Damn right. I look at it
And
as
things get digitized.
good.
And transactions get digitized. So we're not manually entering things anymore.
I look at it as we're all in airplanes, but some of us are in propeller planes, single engine, and then some of us are in jet airplanes. And the jet airplanes, the ones that go the fastest, supersonic speed, the Amazons, right? The Apples of the world, the monsters, they need to be more up to date on things than us smaller businesses. But as we grow, the goal is to go from prop to jet plane. And I think that the accuracy, like you said, has to be more. There can't be a delay in, like you said, I think you called it batch accounting. I love that,
Yeah.
right? You do it at a certain time and it's like you're trying to catch up. I don't think the big companies are operating like that as much as the smaller businesses, where they
No.
do have more free time. They have a little bit more of an ability to kind of clean things up once a month or once every quarter, rather than the individuals who are doing millions and millions per day, which is astounding. So I look at that. Do you agree with me that, as a smaller business, the whole goal is to create the habits that form uh, into a discipline that can't be broken. And as you do it, you get better, more refined. Technology is on your side, and your accounting systems just really start to serve you based off of the habits you formed potentially 10 years ago.
Sure, but maybe I can just add to this. If we take something like accounts receivable, rather than looking at who's delinquent at the end of the month, you have a system that is basically monitoring the likelihood of customers becoming delinquent on accounts that they owe you real time, rather than a process after the event, after they've actually become delinquent, so that it's flagging the behavior on which customers pay you, so that you avoid getting into a situation where you're continuing to sell goods to a customer who's unlikely to pay you for the goods that you've already delivered them. And you get that if you have information which is up to date and you're actually doing something with it rather than doing it in arrears. And likewise with things like inventory buildup. If you can spot an inventory buildup of a particular component or particular goods, it may be telling you that there's a problem with the sales of that goods.
Mm-hmm.
Maybe it's been marketed in the wrong way. That's why I'm saying that accounting systems create the information which allows you to manage the organization better. So keeping on top of that information will help entrepreneurs manage their businesses better. It's not something that's a after the event thought. It's crucial to successful management.
Yeah, I think that's probably why I love service-based businesses. Like you said, there's a few issues that you can stay away from when it comes to inventory and all that. But man, service-based businesses to me are the way to get started in the entrepreneur world. So,
Of course, because you haven't got any goods to finance.
right. Yeah. You basically, you can monetize a solution, right? You don't have to create any type of R&D and all kinds of different, manufacturing plants and shipping models and all that. So it's very easy to get up and running. Now, is it as scalable? That you can argue that all day. Absolutely. I don't think it is as scalable when you have, I mean, obviously flights of an airplane, that's still a service. That's not technically a product, but my God, in my opinion, once you have a product, very much like, let's just say Microsoft with their monthly $10 a month, you can have access to all of their digital platforms. That to me is way more scalable than some of the things that we talk about on this podcast, with starting a business that maybe builds construction, does tax services, does financial accounting, motivational, whatever. So that's what I recommend. It seems like you agree with me if you're low on resources.
I think also that a lot of entrepreneurs do not understand, when they go in early on, they don't really understand working capital management. So if you've got a situation in which your current assets, your inventory, your receivables are greater than your current liabilities, your payables, as you grow, there's a net difference which has to be financed from long-term debt and equity. And the more successful you are, the more you have to raise. And when you're a small startup, it's very difficult to do. If, on the other hand, your current liabilities are greater than your current assets, so you've got more payables than you've got inventory and receivables, as you grow, working capital is actually shedding excess cash, in effect, which you can invest in the long-term assets to grow the company. Completely different operating cycles. And if you understand working capital, it will really help in terms of knowing whether you've got a company which is in the situation where it's continually needing new financing, or if you're in the sort of firm which is constantly providing financing. They're really different when it comes to growth dynamics.
Hmm. Now you do mention in this book, I want to get to it, Ryanair. Okay.
Oh yes,
When I was in
fantastic
it,
organisation.
and so yeah, for those people who are not familiar with Ryanair, it's very big in Europe. And whenever I was in Italy in 2005, I was there for 3 months, so I would travel all over to the different countries, and we would fly Ryanair. It was very
Yeah,
inexpensive. It was phenomenal. I mean, you really could just walk right up to the plane, get on it. I mean, it was awesome. I didn't even enjoy it as much as I really should have because it was so great how inexpensive for us students. But my God, Ryanair, I heard they went through some I guess difficult times since then. So in your book, you outline some of the stories. And is there anything you could share with our audience in regards to Ryanair?
so Ryanair is basically it's been very smart in two areas: cost control and the economic cycle. So let's take cost control to start with. Their aim is to be the cost leader when it comes to budget airlines in the UK, and they have a corporate ethos which says that all the way. So employees at the head office are not supposed to charge their personal devices at work. It's a message to say to everybody, we care about costs, even if they're a really small one. They make as much money from selling, they make a certain amount of money from selling tickets, but they make it almost exactly the same amount again from all the other charges that they have. So they're trying to get you on the planes in the first place. And then if you don't print off your boarding ticket, they'll charge you for that. If you want to take a bag on above a certain size, they'll charge you for that. So they make a huge amount, they make almost as much money from selling that as they do from actually flying passengers. So that's the first thing. The second thing is that they always maintained a really big cash pool. So if you look at their balance sheet, you'll find that they've got a big, and you're thinking, well, why have they got so much cash? And the reason they got so much cash is because the industry, the plane industry, is highly cyclical, and their supplier is Boeing. So they wait until basically all the other airlines in the world are not buying planes. And then they go and knock on Boeing's door. And they say, well, nobody else is buying your planes, but we'll buy a whole load of them. But you're going to have to give us a really good price on those planes. And of course, Boeing is desperate then to get the sales because it's got to keep its factories busy. So they buy the planes at a much cheaper price than anybody else does because of when they buy it in the cycle. And then when they got the planes, in the fullness of time, they refinance those planes and get the cash back. And then they sit and wait until the next time that they need to expand.
Unbelievable. So they are playing the game with a chess-like mentality. And so there is a cycle. Are you saying that it's a consistent approach, whether it's every couple years or every
It's longer
quarter?
than that. It's longer than that for
Yeah,
plane
so
sales.
so basically they wait for the downturn, and that
Yes.
downturn will be different from,
And that's when they buy
decade
planes.
to decade, basically.
Yes. It's very
Oh
smart
my.
because it then means that the cost of running the planes in terms of depreciation is much lower than their other competitors. So they're keeping their operating costs very low, but they're also keeping their capital costs very low compared to their competitors. And because they're owned by Boeing, and because they're a volume buyer, they're buying at the right time and they're buying in volume. So they get a really great price.
Oh, and so they refi and they basically pull all that
Yeah.
money out to have cash on hand, basically.
Yes. That
Wow.
also meant that when COVID came along, they were able to coast through that because all the airlines had a huge problem because a lot of their assets are financed with whenever we buy a ticket in advance, it's providing financing as deferred income or unearned income as a current liability. And of course, when people stopped flying, they lost all of that financing, and that's why a lot of airlines were in trouble. It was not because they weren't having passengers; it's because their financing disappeared almost overnight. Ryanair, it didn't matter so much because they had a huge amount of excess cash. So they were able to absorb that when other airlines basically failed.
Wow. Okay. So are you familiar with a company called Spirit in the United
Yes,
States?
of course.
Is it the exact same equation, same recipe?
I don't know enough. I know Spirit as a consumer, but not as an analyst.
Got it. Okay. So it seems like, from what I'm gathering, it is the same approach, but I don't know much about. I know Spirit was running through some difficult times. I guess it was about a year ago, maybe 8 months ago, and
They
they
all
were.
did because every single airline made losses during the COVID years. That's kind of, and in fact, Ryanair benefits from it
Oh,
because there's a shakeout, and some of its competitors are no longer in existence.
mm. And
So
so
it's become bigger at the expense of some of its competitors who've gone.
So one thing that we talk about on this podcast quite a bit, I guess you could say, is debt, and whether it's management of debt or just not being afraid of it or using it to your advantage. But also, I guess it depends on the asset that you are leveraging. So how do you look at it? You're talking about these individuals who have these assets, they refi, they pull the cash out, therefore they can withstand the storms. When individuals potentially are going to buy a business, I mean, obviously debt is a part of the equation, but how do you
Sure.
look at it? Are you a man who says, all right, the least amount of debt, the best, or hey, it doesn't really matter as long as the debt is actually producing some type of cash flow, or whether
So
it's sales increase?
I'll put my analyst hat on here.
Yeah,
So the value of the firm itself is the value of the equity and the value of the debt. And how much debt you've got does not really change that very much, and as long as it's not distressed debt. So there comes a point at which it becomes distressed, but there is a certain level where basically the amount of debt doesn't really change things, although you get a tax advantage. You get a
yes,
tax bill from having debt. But other than having a tax, if you look at companies in the same sector, you'll find that there's a huge variation in the level of debt that companies have. And they may have similar levels of operating profitability, because the more geared companies have got higher investor returns than the less geared companies. Um, and it's a question of what the appetite of investors is, whether they want to take on the higher gearing of the companies with the higher return, but that's associated with higher risk. It's a neutral thing, with the exception of the tax. Now there is a tax shield, so there is. It is very few companies operate without any debt because it's not efficient.
right.
But if you have too much debt, then it starts to raise the cost of financing, and you get things being priced into in terms of risk. But nobody knows what that limit is. If I go back to the 90s in South Korea, it was not uncommon to see companies with debt to equity gearings of anywhere from 7 to 10 times. Um,
Apple. To me, Apple's in, they have a lot of, obviously, they have tons of cash on hand, but they take on a lot of debt. Same with Disney.
Boeing's a fantastic example of a very odd financing structure. So Boeing has negative equity. It has negative equity by choice. It has negative equity because of the amount of share buybacks that it's got. So it is funded completely with debt and a bit more because its equity is negative.
Wow.
It's not insolvent. It is taking a finance approach to the balance sheet structure because it's got a big market cap. So it's saying, actually, I'm financed with the market value of my equity plus the debt. I'm going to ignore the fact that in accounting terms it's negative because it's a big positive number when I look at the market cap. Very unusual.
Hmm. Yeah, and I've always thought, I mean, maybe since started this journey, I don't like personal debt. I want out of personal debt, but company debt, to me, it makes sense. So personal debt bad, and especially whenever it comes to not, whenever it comes to there's bad debt and good debt, obviously. Whenever it comes to good debt is debt that leads to more money. Bad debt is just a liability. So do you look at the same way? Personal debt bad, company debt good.
Well, personal debt can be good. So I have mortgage debt on which I'm paying 1% a year. I never ever want to pay that off. I'm very happy with that debt.
Yeah, that sounds pretty good.
Unfortunately, I'll have to pay it off eventually, but I'm very happy with that sort of debt. And I've got the rate fixed for the next 5 years, so that's very low risk. And it makes sense for me to basically keep that debt rather than pay it off because it's tax efficient for me. It's hugely tax efficient.
Right. Okay.
Um, so I think it depends what the debt is for, and how it's actually financed. So if you've got somebody who's financing consumption from credit cards, then it's a remarkably bad idea.
Yeah, yeah, right. Right. And
And there are
how about
people
the
doing that.
school? I remember going to Duquesne University. It was one of my first days at school. This is a true story. We walked down into the lobby. They had the banks there with the credit cards for you to sign up at
Sure.
18 years old. I didn't know anything about. Now, thank God I was pretty good with money at 18 years old, but the average person is not. So financial literacy at an all-time low. You have all the freedom in the world as a college student, and now you're given a credit card with potentially $5,000 to $7,000 on it. You're gonna rack that up if you have no financial literacy, and that's all bad debt, plain and simple.
Yes, it's yes,
And then you're stuck. So you wrote a book, and I want to bring this up too, guys.
yes.
If you want to take a look at what other books Stephen Frost is a part of, the Bank Analyst's Handbook, and it's money risk and conjuring tricks. So it seems like it's for the individual getting into the bank industry. And
So,
the
so
more I'm in,
I wrote this basically as a swan song to investment banking. So I'd been a bank analyst covering stocks in Asia for a long time, and at the end of it, I'd had enough of being a bank analyst, and I decided to write a book. And in fact, I wrote it a long time ago, 2004, but sales went up sharply in 2007, 2008, because I've got 3 chapters in there on banking crisis, how to value insolvent banks, and how to resolve banking crisis and insolvent banks. And at the time, there were no other books. There were very few books out there which dealt with those issues. And now, of course, there's a million of them. But it's sold nearly 5,000 copies since it came out, and given that it's always retail for more than $100. That's actually quite good sales for a specialist book like this. It was really aimed at investors in the banking sector, professional investors, and fellow bank analysts. So a lot of people who bought it were bank analysts, either on the buy side or the sell side. I know that because they wrote to me.
well, you mentioned it before, and I want to get to it because when I look at everything you put together, it only makes sense to ask this next question about the currency of the future whenever it comes to, you said AI, but when it comes to crypto, or one thing that I'm kind of getting alarmed in regards to is the BRICS currency, right? Inflation's getting
Yeah,
crazier. The Federal Reserve is printing like madmen in the United States. I think the belief in the dollar around the world is starting to decrease. You have our enemies, or maybe not our allies, creating a new currency. And if all of a sudden the BRICS starts to take form and countries go away from the dollar, we're going to really get into some deep, deep situations that are going to be tough to get out of. So, what do you see in the future? Are you alarmed of the crypto? Are you excited about it? Are you afraid of BRICS? Are you excited about it? What's your thoughts on all that?
so I'll give you 2 answers. The first one is that I met the chairman of UBS, which is one of the 20 largest banks in the world, a few months ago, and he was asked a question about crypto. And he gave a fantastic answer. He said, "I've learned not to talk about things that I don't understand."
If more people adopted that, huh? Yeah.
But if I want to be speculative, I think the end of the US dollar is the reserve currency of the world. It will be a long time before anything displaces that. The US has a lot of debt, and if you look at the amount of debt which is held in China, which is, I don't know, maybe $3 trillion. I've not looked at it recently, but it's actually a relatively small amount of the total debt that the US has, and it is the big benefit that having the reserve currency of the world is that you can issue debt and foreigners will buy it, and you don't have to worry about defaulting on it, because at the end of the day, you can always either devalue that debt, which is what the Chinese and other foreign holders would be concerned about when inflation increases in the US. It devalues the value of their T-bills and T-bond holdings, of course. But the other thing is that you can literally just print money to repay it.
Right.
And that's a huge advantage. And it's going to take a lot of years before that changes. Now, maybe it will change, because all empires come to an end eventually.
Yeah.
But when that will happen, if you look at the US as the share of global GDP, it's been in relative decline since fairly soon after this end of the Second World War, in relative terms, because everywhere else has grown faster. But it's still it's still the largest economy in the world. And on a per capita basis, even though China's got comparable GDP, it's a much, much richer country than China. But what will happen in the future, I don't know.
Wow. Yeah. So from what I gathered, the countries that have signed on, it's like, what is it? There's more than, I think there's supposedly almost 40 countries that have signed on to be a part of BRICS. And I'm just thinking of population. I think the top 5 or 6 people who've signed on to BRICS is 45% of population in the world. The moment they get to 60, 70%, I just think that it's going to get shaky, right? There's going to be more
It's
people shifting
possible.
over.
China still maintains a quite tight control over its currency, so it's not a freely convertible currency. It doesn't have a free capital account in the same way as Western countries do. And as long as all commodities are priced in US dollars, this
Yeah.
is a personal view. I'm not an expert in this. I think it will be a way off.
Good deal. Yeah. Well, you're an optimist, it seems like. You're very positive, and I hope you're right.
Yeah,
I hope I'm 95 years old and I'm living on an island, and then maybe shit hits the fan before I start to see anything. But
I think
uh
sometimes people worry about things when they shouldn't. No, trade generally makes everybody better off. You know,
I like your viewpoints. But Stephen Frost, who guys, you guys check out his both books. Very smart man, based in the UK still. His book, you said it, you put it in layman's terms, basically simple to read. Even I'm a
yeah,
finance major. I was like trying to stay awake in school, but I was reading through some of this in the sample, and it's really easy to understand. So financial accounting and reporting for non-accounting students, how to interpret financial statements and appraise company performance. I think if you're an entrepreneur out there, to understand this to a high degree will give you an advantage, a leg up in the boardroom. So check out his book. But is there any website or social media that you'd like to recommend to our audience, Steve?
I don't. I have a LinkedIn account which I'm always happy to connect with people and chat to via.
Beautiful. And so if they ever got in touch with you, what would you be, or do you educate people on stuff, or is it just check out the book? Do you do consulting at all? How do you offer any type of your services?
I'm really busy with my full-time job.
Oh,
Um,
so maybe don't reach out to him for advice, but check out his book because there's a lot of content. And by the way, if you're selling these many books and they're priced, $40,
yeah,
43
very
bucks.
affordable.
The other one, yeah, and it has a lot of content. So check it out. How to interpret financial statements and appraise company performance. Stephen Frost, I can't thank you enough for being here, man. I don't know
Thank
what
you
time
very
it
much.
is.
I really enjoyed it.
What time is it in the UK right now?
It is 3:45 in the afternoon.
Oh, okay, so it's not too late. All
I've got
right.
one more coursework to mark, and then I can go home.
All right, man. Well, thank you for giving us some of your time, some of your wisdom, and really appreciate it, man.
Thank you very much, Mike, and take care.
Remember, guys, $1 million book will lead to $1 million life. Right on.